For years, one of the biggest drivers of silver demand has been China. Not investors, not central banks, not even electronics, solar panels. China's massive solar build-out became one of the largest consumers of silver on Earth, helping create one of the most persistent supply deficits in modern commodity history. But now, cracks are beginning to appear. Analysts at BMO are warning that Chinese solar capacity additions are tracking below 2024 levels, potentially reducing one of silver's most important industrial demand drivers. Most investors hear that and immediately think bearish for silver. But what if they're looking at it backwards? Because the real story may not be disappearing demand. The real story may be a transfer of demand, a transfer from industrial buyers to investors. And if history is any guide, that transition could be explosive. Let's start with the supply side. The silver market is projected to remain in structural deficit for the sixth consecutive year in 2026. According to the World Silver Survey 2026, the market is expected to experience a deficit of approximately 46.3 million ounces this year. Think about that for a moment. For 6 straight years, the world has consumed more silver than it has produced. The result? Inventories continue to be drawn down. Since 2021, roughly 762 million ounces have been removed from above-ground stocks to bridge the gap between supply and demand. That's not a temporary imbalance. That's a structural problem. And structural deficits don't disappear simply because one industry slows down. They usually shift somewhere else. To understand why this matters, you have to understand China's role. China dominates global solar manufacturing. The country produces the vast majority of the world's photovoltaic panels and has become the epicenter of silver consumption in the renewable energy sector. Research has estimated that solar demand could account for roughly 1/5 of global silver demand, with China at the center of that growth. For years, China's solar expansion acted like a giant vacuum cleaner. Every new panel required silver. Every new manufacturing line required silver. Every new government incentive program pulled more ounces off the market. That industrial demand helped create the deficits we're seeing today. But now that relationship is beginning to fracture. BMO recently noted that Chinese solar capacity additions are running below 2024 levels. Meanwhile, solar manufacturers are increasingly attempting to reduce silver usage through thrifting and substitution technologies, because silver prices have risen so dramatically. That doesn't mean solar demand disappears. It simply means growth may not be as explosive as it was during the last phase. And that's where things get interesting. If Chinese solar demand cools slightly, where does that silver go? Many analysts assume it creates excess supply. But that assumption ignores a critical reality. The silver market is already in deficit. There is no surplus waiting in warehouses. There is no mountain of excess metal sitting idle. The market is already short. Now imagine what happens if another round of monetary easing arrives. Imagine the Federal Reserve returning to large-scale liquidity programs. Imagine recession fears rising. Imagine renewed concerns about debt, inflation, and currency debasement. Historically, those conditions push investors toward hard assets. And silver has a unique advantage. Gold can become expensive for retail investors very quickly. Silver remains accessible. A retail investor can still buy physical silver with a relatively small amount of capital. We've already seen evidence of this substitution effect internationally. As gold prices surged, Chinese investors increasingly turned towards silver as a more affordable precious metals alternative. The same dynamic could emerge globally. The silver leaving the solar market may simply be absorbed by investors seeking monetary protection. And investment demand tends to be much more volatile than industrial demand. Factories buy silver because they need it. Investors buy silver because they want it. That's a critical distinction. Industrial demand is usually steady. Investment demand can become emotional. When fear enters markets, investor demand can rise dramatically in a very short period. Reuters reports that coin and bar demand is expected to increase substantially in 2026, even as some industrial demand softens. That means one category may already be replacing another. And if monetary policy becomes more accommodative, retail participation could accelerate. Remember what happened during previous precious metals bull markets. Retail investors didn't wait for perfect fundamentals. They responded to inflation fears, currency concerns, banking stress, and monetary expansion. Silver often becomes the affordable gateway asset. This is why price forecasts continue to attract attention. According to Capital.com, citing major institutional forecasts, J.P. Morgan maintains an average silver price target of approximately $81 per ounce for 2026. That's not a retail YouTuber. That's one of the largest financial institutions in the world. And the reasoning is straightforward. Persistent deficits, tight physical supply, strong industrial demand, and the possibility of renewed investment flows. Even if Chinese solar growth slows, those other forces remain firmly in place. The silver bull case was never dependent on a single source of demand. Not solar, not electronics, not jewelry, and not investors alone. The bull case is based on a much larger reality. For years, the world has been consuming more silver than it produces. Now, one of the largest industrial demand engines in the world may be slowing. But instead of ending the bull market, it may simply be handing the baton to investors. If the next phase of monetary easing arrives, if liquidity expands, if retail investors begin searching for hard assets again, then silver could find itself supported by an entirely different class of buyer. The factory may step back, the investor may step forward, and in a market already running a structural deficit, that transition could become one of the most important stories of the decade.